Welcome to the webinar today. I hope you all saw that video while we were getting you all in place. K Properties is bringing in today one of our speakers here, which is Che Lappin. He is the president of K Properties and Investments, and he has an extensive knowledge of Delaware statutory trusts. He continues to guide the firm's success, helping complete over $30 billion in investments. That's 30 billion in investments. So he definitely knows what he's talking about. Mr. Lappin's insights are often in top industry publications, including Forbes, Yahoo Finance, and MarketWatch. He was a top-ranked U.S. water polo athlete and represented the USA in the 2012 London Olympic Games as part of the U.S. men's national water polo team. Very cool, Che. We're so glad to have you with us. Before I pass it along to Che, I do want to mention just a couple of things for you all tuning in. One is, of course, per usual, we are recording this webinar for you, and we will be emailing it to you tomorrow with Che's contact information. So keep an eye out for that. And we will also have a Q&A session with Che. So if you do have questions, don't hesitate to put them in the Q&A box. The Q&A box is better than the chat because it helps us stay a little more organized. So please put your questions in that Q&A box, and we'll be sure to get to them at the end of this presentation. And for now, I will go ahead and pass this along to Che to get started, and I'll get off camera here. Thank you, Che, for joining us.
Yeah, thank you for having me, and we appreciate everybody either logging in here live or gonna listen to us in the near future. So to dive quickly before we get into the nuts and bolts here, we always like to start with some risks and disclosures. Ultimately, everything we discuss here, is not intended to be legal or tax advice. We highly recommend all of our clients or potential clients to engage their own CPAs or legal teams, as everybody's situation can be different, especially within a 1031 exchange. And some people have different ownership structures, whether it's partnerships or different trust structures. And although there's likely to be a way to do a 1031 exchange, we just want to make sure all of our clients are going down the correct path. We have a lot of experience, between our founder Dwight K. and who's been in the space for about 2 decades, focused on the DST specifically, and myself having extensive background in the space of over a decade. We've seen a lot of the questions and the situations, and we can, if you have a high level question, we could definitely, most likely point you the right direction. We just don't want to, come off as, that, on these complex questions or situations, we want to make sure that you engage. And some people, it's very simple. You just own your property in your own name or your own simple family trust, and there's not a lot of moving parts. Also, another item to note is all of the investors inside of DSTs, Delaware Statutory Trusts, which if you're brand new, we're going to dive into what that is here on this webinar. But in order to invest into a DST, you have to have a net worth of over $1 million exclusive of your primary residence. And that's for individuals. So, and that it's not cash. You don't have to have $1 million in cash sitting in your bank account, but you have to have a net worth of over $1 million minus your primary, your home that you live in. So you can count all your investments, you can count cash, you can count the buildings that you own that are held for investment purposes. So like to lay that out. If you are an entity, which means like a partnership or a family trust or some sort of LLC, those entities have to be accredited, and those entities can typically be accredited in 2 different ways. One, all the underlying owners, so all the people that are the owners of that entity are accredited investors themselves, or the entity itself has more than $5 million of assets inside of there. So if that entity had a $7 million building, then by default, that entity would be an accredited entity. If you don't qualify for either of those, there are some other income requirements that could potentially qualify you. You could reach out to us one-on-one. Um, so now, diving into just a quick background on our firm. Here at K Properties, we are real estate focused. That's kind of what we advise and what we've been specialized. And all of the unique thing is, most of all of our advisors have come, or at least all of our senior advisors. Obviously, we continue to hire great new people and lead them, but all of our senior advisors have extensive experience within the real estate world itself, and the DST world. And that's important because this is not just an investment into a financial vehicle. There's other complexities there where, you're ultimately investing in an underlying asset. And so, our job, you might know and understand what a multifamily deal is because maybe that's what you currently own and operate, or you know retail, or industrial or single family residence, or you might know it all, but our job is to walk you through pros and cons. And I think, the experience of K Properties being involved in, at this point, almost $40 billion worth of DST offerings, that really gives us a high exposure. And these properties are all over the country in all different asset classes. And so you can imagine the data that we have access to and the data that's constantly presented to us on a quarterly basis or a monthly basis on financials. We can really get a sense on how properties, asset classes, different geographical locations, different, economic environments, exist in different areas of the country at different times, and convey that to you, right? Because all real estate can go through cycles, just like all investments, whether you're in the stock market or other investment vehicles, you can go through cycles. And I think that's one of the reasons why the DST has become more popular and more mainstream over the past, decade, the most recent decade, is because investors are realizing that things move fast. News travels fast, which means that it can affect markets faster. And with technology, it's going to continue to move faster. With AI coming in, different how that's going to affect different industries. And so with all of that, being able to create a diversified portfolio of real estate investments, assuming that you're comfortable with the different pros and cons that we would educate you on, it really can potentially isolate through these cycles because you might be diversified. You had originally had owned $1 million single family house or a $5 million apartment building or a $20 million retail center, but you were only concentrated in that one building, or that one location. And if there was a local recession or maybe a big employer left that market, or a earthquake or a storm, whatever it might be, those black swan events, to have that concentration to a diversified portfolio of DSTs where you might have 5 or 6 different asset classes in, 5 or 6 different geographical locations that provides 5 or 6 different economic drivers. Because you could be in Virginia Beach where the market is more heavily reliant on government, military, and other contracting services that come along with that, versus another market that might only be reliant on oil and gas or entertainment or tech, different things along those lines. So those could all go through different cycles, and that's why we highly recommend diversifying. It doesn't necessarily protect you against speed bumps and potential risk factors, but it could definitely mitigate those issues. And so, here we are headquartered in Torrance, California, which is Los Angeles. It's kind of the near the beach cities of Los Angeles. We also have offices and people amongst our companies in Texas. And then on the East Coast, up in the Northeast, we have a presence, and in North Carolina, we have presence there. So it really gives us the ability in two capacities. Our team members are licensed across all 50 states, and we have clients. We have, I think at this point, this stat is behind, but we have thousands of clients in over probably close to 10,000 DST investments. And we have people that our clients can reach out to anytime. We really work in as a team approach here at K Properties. We're not like a real estate brokerage where, that's a bunch of 20, real estate brokers that kind of all have their individual businesses. We work as a fully integrated, real estate. We've really institutionalized this space, and to Dwight K, our founders, credit, we were one of the first firms to institutionalize. I like to use that term, but institutionalize the DST industry and really zero in on that, because most people who offer DSTs, I'm not saying this is good or bad thing, but they're generally like a wealth advisor or a financial advisor. And we have those same, or we have to have those same types of licenses, but we decided we are focusing on the real estate aspect of it. We're not going to do stocks, bonds, insurance, the whole portfolio, even though some of that we can do. And we have a large client base that we could tap into. But I think that specialization has allowed us that hyper focus to kind of grow to the size we are today. So please, at any time, I know sometimes gathering questions on a webinar might be a little more difficult, but things are going to come to mind, and, email myself. I'm always accessible. Dwight, our founder, is still 100% involved in our company. And, we have roughly 40 people here on our team in the Torrance location at any given time. So, and come visit us if you're, a lot of you, I imagine, are relatively local. We do a lot of in-person educational events at our office and or nearby. So, definitely feel free to stop by and meet the team there. So now we're going to dive into the 1031 exchange and, ultimately what we're, kind of talking about today. And so I would imagine a lot of people are familiar with it, but, the idea of a 1031 exchange is to defer your tax when you're selling a piece of investment property that was held for the use in trade, business, or investment purposes. I imagine most of our clients, it's an investment property, but we have had clients that, had a business with a real estate component to it, and they sell it all and utilize us as an option. But there are a few rules within the 1031 exchange in order to defer 100% and being, ultimately being compliance with the IRS. And that's here on the slide, but this is where you want to be hyper-focused initially. And it's not necessarily rocket science. There's just little things here that we've seen people unfortunately mess up on, and it might not even have been their fault. It could have been a real estate agent or an escrow company. And a lot of this can be completely overcome and clean and easy by just preparing ahead of time and working with our team. We'll definitely keep an eye and make sure that things are set up properly. But the most important thing is to get a qualified intermediary, or some people call them an accommodator. They are the firm that's going to hold your money. So when you sell that piece of property, whatever that investment property was, you cannot receive that money in your own personal account. That's an automatic failure of a 1031 exchange. So that's where I've seen that happen on accident. So you really want to connect your escrow company with the accommodator. And because they're going to wire to that. So our team isn't physically touching your money. You're not physically touching your money. It's going into a third-party escrow account, waiting on a direction of buying an investment property. I would highly recommend sticking with a large accommodator. We are not an accommodator. We don't make a fee on these accommodator fees or intermediary fees, but we can recommend a handful of the large accommodators. There's a lot of small ones out there, probably a lot of great small ones, but when you're dealing with probably a very large chunk of your net worth, I would ideally probably want to be with a company that is fully bonded, licensed. So like Fidelity Title has an accommodator, Stewart Title, some of these big title companies or some of the big banks. So, feel free to email, we can get you that. So you set up your accommodator account. Then the other rule, if you want to have a full tax deferral, is you have to reinvest 100% of your net sales proceeds into replacement property. So, if you had $2 million move into your accommodator account or whatever the number is, we work with all sizes of exchanges, as low as we've done a $50,000 exchange. We've done as high as over $100 million worth of exchanges with a client. And so that money has to be fully reinvested. So if you got $2 million in there and you only buy $1.8 million worth of property, that extra $200,000 might cause you some sort of tax consequence if you didn't reinvest that. Now, we do, and you'll hear our team when we were talking to clients, when you're selling this property, we always, walk the clients through that. Hey, do you want to take any chips off the table? Do you want to pay some pro rata portion of tax? You'll, obviously talk with your CPA and see what that looks like, because maybe you want to have a nest egg on the side. If you don't already have a healthy piece of that, maybe you want to, you've done a lot of hard work to get that property to that $2 million mark, and you want to pay some tax and go have fun, or help your kids or grandkids, whatever it may be. So you can absolutely do a partial 1031 exchange. You just want to make sure you understand that tax consequence. So, and then the third is and this is assuming you're not doing a partial exchange, but purchase equal or greater value from what you sold. So if it's pretty easy. If you had your $2 million property and you were debt free and you sold, and then $2 million moves into your accommodator, and then from the accommodator account, you buy a $2 million debt free, that's clean. You just accomplished that number two and number three that you see there. But what if you had debt? What if you actually sold for $4 million, but you had a $2 million loan? So you had to pay off the $2 million, which left you with $2 million of net proceeds. Well, the government wants you to buy, or the IRS wants you to buy at least $4 million, because that's what you sold for, not minus the loan, what you sold for. And so the way that you can accomplish that is in two ways. The most common way is to get another loan, buy another $4 million plus property. In our DSTs, we have DSTs that are debt free, and we have DSTs that have a debt component on them. I'll dive into that in a future slide, but that's how we would accomplish absorbing a new loan through the DST to get you to that $4 million. Or some clients, we have actually a client right now that is selling for around $1 million, just using simple math. But he's selling for around $1 million. He has approximately a 50% loan to value, so he's only going to get $500,000 back. He's a little more conservative, and he came to us and said, you know what? I have a lot of liquidity on the sideline right now. I don't really want to get involved in another loan, so I'm just going to add $500,000 to my exchange. So you could add money. So in that example, he only had 500,000 in his accommodator account, but he needs to buy $1 million. So he's going to add $500,000 of cash to equal that $1 million and just buy $1 million worth of debt-free DSTs. So there is that balance of an approach. But if you don't have or don't want to add a bunch of cash, there is the debt component to take care of it. Number four here is you have to identify, essentially pick your investments within a 45-day period of closing whatever your down leg, your property that you sold. That's a pretty fast window, 45 days, month and a half approximately. If you're going out and buying or finding properties on your own, we all know that by the time you do site visits, your negotiations, working with attorneys, uh, making sure that, doing third party like environmental reports, property condition reports, like that all could take up to 45 days or very close to it. And so when you're buying your own property and you start doing that exploration during your 45 days, you might end up having to identify a property that you don't fully have all the info or due diligence on. And so I've seen clients where they, pass their 45 days, they have identified, some, eightplex in Long Beach or whatever it might be. And next thing you know, they get their environmental report, or next thing you know, they get retraded on terms with the bank, or, next thing you know, after getting all the estoppels back, you find out there's a bunch of bad debt in there, whatever it might be. Now you're stuck. Now you're deciding, do I have to buy this property I'm not comfortable with, or am I going to pay my tax? And so what I bring that up as an example because DSTs might not be for everybody. This might be for something you're just exploring now, something for the future. You're still wanting to be an active manager, have control. You don't want to be diversified and passive right now. And so, but you might still have 1031 exchanges. So you could utilize us as a backup, right? So if you went to you're going through your due diligence on your primary option, and then number two on your identification, or number three, you could add in some DSTs kind of as like almost like an insurance policy. Obviously, we want to make sure you're comfortable with those DSTs. Don't invest in them if you're not. But um, that's where I've worked with a lot of people that are still hands-on, or even some mid-size institutions. They'll utilize, or family office type clients where they'll utilize us for backup. It's difficult in today's market to find quality real estate, um, and get A to Z on it. The other unique thing is the coverage. So if you're an investor where you primarily still want to have control, you're just kind of lightly exploring this DST. If you have a $5 million property that you sold, or whatever the number is, it's going to be hard, most likely, to find an exact $5 million to replace if you're trying to find something on your own. So what that's going to force you to do is, you might find a perfect $4 million building, but now you still have $1 million delta. Or your real estate broker is going to show you, a $5.5 million, a $6 million. So you're going to have to, extend yourself with more loan or more cash to buy that property so that you at least cover the $5 million. So DSTs can be very interesting because if you were to find a perfect $4 million building that checked all your boxes and you have $1 million left over, or even as low as $100,000 or $50,000 left over, you can use the DST in conjunction with the property that you're buying and have a full potential tax deferral. So that's another interesting aspect that I see a lot of sophisticated investors doing that, again, are not necessarily ready yet to take the full passive step. So this is just another illustration of kind of the flow. This PowerPoint's available. If you were to go on our website, you could download it or just request it from us. If you kind of wanted to get this piece. So what does like-kind property mean? So a lot of investors that we've come across over the years will take that a little literal, meaning, if you sold a multifamily building, that means you have to buy a multifamily building, or you sell an industrial, you have to buy an industrial. Like-kind property actually refers to the nature and the character of the property, and that it must be held for productive use in trade, business, or for investment. So you could sell ultimately a office building and exchange it for a multi, or sell a apartment building and exchange it for land. Or, and I think you guys kind of understand the flow here, but I do like to point that out, just so that if you're kind of narrowing down what your direction you're going to go, and also to let you know this allows for that asset class diversification that I was mentioning earlier. And so now we dive into what exactly is a Delaware statutory trust. So a DST is an entity used to ultimately hold title to the real estate. So if you were to, say we had a FedEx distribution center, those DST down in, Dallas, Texas. If you were to go pull title on that, you would see that the owner of that property is the entities of the DST. It's the same concept as, if you own your primary residence and your family trust, more than likely, if we walk down to the county, hold your title, it would be your family trust, not you as individuals that own that property. But inside that family trust, there is undivided beneficial owners of that trust at a certain percentage. So like my family trust, my wife and I own together at 100%. But some people might have, husband, wife, or relatives, or, friends that are co-owners of that trust at a certain percentage. So it's the same thing with the DST. Dependent upon how much you invest into a particular DST, you might be a 1% owner, you might be a 10% owner, and you will get the potential benefits of 10% of that underlying asset, which in this case, the underlying assets in these DSTs is whatever that real estate was. So you get 10% of that net income, you get 10% of that potential appreciation, 10% of any potential tax benefits that might flow through. It's like a pass-through entity. So if depreciation is a big topic in today's world, it's a very healthy tool currently to shelter income. These provide depreciation. Now, everybody's situation is different. When you do a 1031 exchange, you are carrying forward your basis. So you want to talk. And some people, you've owned your property for 30, 40 plus years or a very long time, you might be fully depleted or almost, therefore not a lot of depreciation opportunity. That's where you might consider, now you want to make sure you understand the risk, but that's where you might consider utilizing a DS2 with debt to absorb new properties. So that's why some people, even though they might have originally owned $5 million worth of property, but they're fully depleted, if they go buy $7 million worth of property, that extra $2 million might provide a brand new basis of depreciation potential. And so we can do that in the DSTs where you utilize a debt component on a DST to buy more property. And so you can talk with us, and then we will, obviously make sure you kind of relay this information to your CPA. The biggest difference between a DST and other entities like an LLC or a partnership is the DST allows for that like-kind exchange. You can't necessarily just do a 1031 exchange into some LLC real estate investment that you see on a crowdfunding website, or some of these online investment forums. It also allows, when the DST is sold, when that business plan is completed, that all the investors can go do a 1031 exchange on their own, go their own direction. If it was a normal LLC, say that you just did a cash investment into some crowdfunding deal on a crowdfunding website, or some real estate partnership, when that has a liquidity event, the only way to defer that tax would be if that partnership or that entity and all those investors inside moved in an exchange together. So they all moved into the exact same thing. They can't go their separate ways. There might be a few ways to do that with drops and swaps and stuff like that. But generally speaking, to keep it simple, you can't easily separate. And so the DST gives that flexibility. And the thing that I like, kind of spinning off topic here that I think is going to become more and more interesting in our space, and I'm already seeing it over the last couple of years, is DSTs are not our structure, our investments are not just for 1031 exchange equity. You also can just do a cash investment, and especially in today's world where although we've been going through very interesting times, there's a lot of wealth on the sideline, a lot of liquidity in savings accounts. A lot of people have just kept it in the high yielding savings accounts because they feel that 5+% they've been receiving is safe, and why put it in some other investment when I can just get it a safe 5%. Well, that 5% is going to start going down because as interest rates drop, that's going to drop. Bonds are not going to be as attractive potentially. And we're not saying pull out of that, but people looking to diversify a little bit out of that and get into some real estate investments, you could put cash into a DST investment, and now it acts and feels like real estate. And then when that cash investment is sold, when that DST is sold in 5 years, you can now do a 1031 exchange. Also, as a cash investment, typically a lot of that current cash flow, again, everybody's situation is different, but a lot of that current cash flow is very highly sheltered because of depreciation, or if you're in something with debt, interest deduction, all of that stuff that's why people buy real estate in the very beginning. But real estate's expensive. So if you wanted to get in the game with fresh new real estate, you're either going to have to buy a quality piece of real estate. You're going to be spending, a couple $1 million, or you could take that $1 million of cash that you were going to go buy a duplex or fourplex with and put it across and build your own mini portfolio of real estate that you're going to get all the same potential benefits. Some of our properties also have cost segregation reports that even more help with that depreciation loss. So getting back on topic here, some frequently asked questions on the DSTs. What is a DST property? We kind of, talked about that, but it's a type of replacement for 1031 exchange and cash investments. Has the IRS approved the use of DST properties for 1031 exchange? And the answer is yes. The DST structure has been approved by the IRS as a 1031 exchange compatible under the IRC Revenue Ruling 2004-86. So it does have a revenue ruling. There's some things out there in the IRS realm where there's just a guideline. This actually has a revenue ruling, which I think holds stronger. So how quickly can an investor close on a DST? Typically, it's 3 to 5 business days once you decide on the property you're going to go into, because these are live assets. The DST already owns the property. That's another thing, that comes to my mind right now. As a cash investment, a lot of real estate investment opportunities out there, and they're not bad. We offer them too on our platform, but you're investing into a fund that kind of is like an open-ended fund, meaning the manager, the sponsor is telling investors that, hey, we are targeted to raise $100 million or $50 million, whatever it might be. And once we raise that money, or as we raise that money, we're going to go buy a certain type of real estate. And so as you raise money, you got to get that money working fast, or as fast as possible as the sponsor, to start, building the returns for investors. With the DSTs, it's kind of a reverse. The property exists already, and then the money's coming in and working right away. So it's kind of unique. And I'm not saying don't have different fund structures. Sometimes there's potential higher returns in those. And so those, could absolutely be part of your portfolio. But as you're allocating a cash investment, you might diversify a little bit more in different strategies of like DSTs and different fund or development deals, things like that. So the reason why DSTs, coming back to this, can be closed very fast, and the reason why it's already available is so that we can satisfy 1031 investors. Because a 1031 investor, there might be a DST that raises $50 million, but it's going to be over a 6-year period. But you can come in with your exchange, have successful exchange. I could come in 3 months later, have my successful exchange. So it's unique in that. So now diving into typical asset classes that you're going to see on our platform. And I'm going to kind of move through this fast for the sake of time, but we have multifamily, Class B, Class A, your typical long-term net lease properties. So a lot of people are familiar with net lease properties because if you're on this webinar or listening to this means you're probably considering being a passive investor. And triple nets are another quote unquote passive investment, or more passive. The only thing is, I think triple nets can carry a lot of risk. We work with them every day, but I mean that by you're just over concentrating yourself into a investment that's relatively passive, but still has some management aspects. I have a sister company. We're getting close to $1 billion worth of property that specifically is almost all on a net lease structure. And I have a team of 20 people that are just hyper focused on that. And then we have people outside of that, but hyper focused on that. And there are management problems with triple net properties all the time, from making sure the tenants are abiding by the lease, different reimbursements going on, dealing with insurance companies. There's still headaches. They are not 100%. DST is truly one of the only 100% passive investments out there outside of you filing your taxes every year, but the actual properties itself. Also, a lot of net lease properties are big corporations. They'll try to push the landlords around, So being with some of our sponsors that are on our platform that might, we have some sponsors, one sponsor, I won't name the name on here, but they're one of the, some of the largest owners of they're the largest landlords of some of the largest companies in the United States, if not the world. Will they get pushback from these corporations? I'm sure. But if you, as the mom and pop, just own that single asset, individual owner, they're going to push you more than they're going to push the big sponsor, most likely. Obviously, no guarantees, but so you get some, institutional management with these, and that can go head to head and have legal staffs and things like that. During COVID, it was a perfect example. Again, I'm not going to name the tenant because I don't want to cause any trouble, but there was a tenant out there that everybody knows, one of the largest corporations in the world, and they're in the service industry. And during COVID, they sent letters to all of their landlords basically saying, hey, we're not going to pay rent for X amount of months because COVID's going on. Well, all of their locations, their drive-throughs were open. If you drove by them, they had longer lines than you've ever seen, especially during COVID time, because it was probably one of the only things people could go out and do. And they were trying to take advantage of people who got scared, individual owners who got scared and just said, okay, fine, you can have free rent or reduction. I don't want to, upset this big, Apple Card. Where all of our properties that fell into that, we said, our legal team got right on, that's not going to happen. And the checks came right in. And so that's just big corporations casting out the net of, 5,000 properties, and maybe 1,000 people do a reduction. And so there's, gains like that. But we have self-storage properties, medical, or industrial, multi-tenant retail. Again, some will have a leverage component, some have a debt-free component. And so this is where I'm going to kind of run through fast, is just some examples. And at any given time, we might have 30 to 60 different live deals on our platform, and then a bunch coming behind that. So feel free to, stay in tune with our website. This was a debt-free multifamily deal, outside of Nashville. We've had investors in this deal. These are fully subscribed, so these are not available. These are just examples. But we've had investors in this deal for a good amount of time now, 5 or 6 years. And I think we've had 5 or 6 rental increases. So, it's done very well for investors. These are examples of like triple net properties. The nice thing about triple net properties is obviously you have a corporate guarantor. So even during these interesting times, they have performed very well. You just don't want to be all into that one property. People don't realize if you have to reposition any commercial building, it's a lot more expensive to reposition any triple net property than it is, what you might be used to, like a single family house or a residential property. So we like them because they weather, insurance. I don't know if here in California, all you have felt the insurance yet, but you probably are if you haven't already. Those costs are going up 2 times, 3 times, 4 times, 5 times the cost. That's going to hit everybody's cash flow. Most people, when you actually look at a 5-year horizon and of especially California properties, they've appreciated well, but when you look at the cost to run those and the random expenses that pop up, AC fixes, roof repairs, landscaping, plumbing issues, and you look at all your expenses over a 5-year period, and then look at your net income, and then you have insurance costs going up, people might be negative at the end, a negative, return on their investment or a 1 or 2% return on their investment. Triple net properties are nice because as insurance costs raise, most triple net properties, you're passing that through to the tenant. And so your net cash flow outside of the tenant going bankrupt is remaining stable. So we do like triple nets. I don't want to necessarily say they're horrible. Just we want to have a diversified approach. We've done a lot of FedEx distribution centers. That's a good mix of a triple net and an industrial and distribution logistics, which is, obviously become very popular in the recent years. For Cineas, this is, an example of a medical type tenant, but with a, billion-dollar company behind it. This was a Class A multifamily, I think, a couple years ago in the Houston market. This little area of Houston is like the hip area, Montrose. A lot of restaurants, kind of targeting 20 to 40. So a lot of young to mid-age people. Amazon distribution centers, we typically have had one of these at, every year. Amazon, we all know. So, ultimately, kind of to round this off, why do people consider DSTs? We've all heard of the 3 Ts, the cheesy statement, no more tenants, toilets, and trash. The goal is to have a professional management that you don't truly have to worry about. They're always available if you want to be in tune. But when I say worry about is just dealing with, the different components. So again, people who just want to be passive, they've built their wealth, want to diversify, enjoy their life. Or like I was saying earlier, we have a lot of sophisticated investors who will utilize us for other strategies like the cover, the backup, or, they just can't find something that makes sense, but they have a great opportunity to sell at a inflated price, or they have a loan coming due and they can't refinance to make it make sense and re-put that capital into DSTs. So minimum investment, 100 grand, but there is flexibility there. So if you wanted to ultra diversify or you want to do a test investment at a lower amount, just reach out to us. And we're more than willing to help you there. To kind of lightly go over risks of financing, the DST is nice because the debt is all non-recourse, meaning you as the investors are not going to sign on those loan documents. You won't do a single loan document. You get the benefit of the debt through the pass-through, but you're not going to sign on those loan documents. You're not going to have to qualify for that debt. The debt's not going to go on your credit report. So it's kind of neat. You get the benefit of all the debt. There's risk to the debt. You could lose your investment, but you're not on it personally. God forbid there was a foreclosure. You're not going to be on there to, go after your personal assets per se. But debt has benefits from either you might have to utilize the debt to satisfy that 1031. You might add in debt to get more tax benefits. We have all that. We just want to make sure we walk you through the risks. And a lot of our debt is anywhere from like 30 to 60%. And if you have a higher loan to value, there's some ways that we can accomplish that up to and around 84, 85% loan to values. We've come across some clients where they've recently like refinanced and stripped all their equity out of the property. So they're at like an 80% loan to value, but you've already cashed into your value. Now you're just looking to not pay tax on that. So that's where we can maybe help you on a higher loan to value situation. And so I mentioned this earlier, when a DST property is sold in the future, you will have the opportunity to do another 1031 exchange, as long as the government has the 1031 exchange available. How does DST property work in regard to distributions, appreciation? This is not a partnership where there's like a waterfall with the manager. Everything, obviously there's fees involved, different on the ongoing, like property or asset management fees, but the net cash flow after whatever the structure is goes to the investors pro rata. If there's a $10 million investor and a $100 million investor, they're treated equally. So it's undivided. No one has, no one's higher than the other. And then on the sale, after all closing costs, 100% of the proceeds are pro-rated out dependent upon the ownership percentage. In terms of taxes, you do not receive a K-1. At the end of the year, you'll get a tax package that will essentially have like a substitute 1099, your gross income that was received on the property, and then everything to kind of deduct to arrive at that net number, generally going on your Schedule E, which is what you probably are doing now. If you have any questions, we have different contacts. We have a CFO on staff. He will not give you direct advice and or do your taxes. But where we find it very helpful is if your CPA has questions, they can get on the phone and speak the language together. If you have the flexibility to stay debt-free, there's obvious reasons to be debt-free. It's more conservative. You don't have the risk of foreclosure. You have staying power through difficult times. There's no refinance risk, no cash flow sweeps. A lot of people don't realize in debt deals, when you have a loan on a commercial asset, there's usually provisions where if a tenant becomes underperforming, like say the credit agencies downgrade them for whatever reason, they could sweep that cash flow, meaning even though the tenant's still paying rent, they can bring that cash flow into a lockbox until they feel it's stable enough to release it to you. That could go on for years, quarters, just depending on the situation. That's also the benefit of diversifying. If that were to happen, it's not all your eggs. It's rare. I see it happen though. Probably I see it happen more often or hear about it from investors on an individual basis. But if you have questions about that, let me know. Also, no prepayment penalties is a big one. I know I'm not going over all these just because we're coming up against the hour here, but prepayment penalties, you could have an off-market offer, but if you have a 10-year loan, you might have a big defeasance prepay situation where even though the offer is at the table, you can't sell it because the prepayment's going to hit in or eat into all that profit. If you're debt free, you could really exit early if it makes sense. You could hold longer if we're going through a recession. So it just gives a lot of flexibility from that standpoint. Now, to wrap things up here, please feel free to visit our website, www.kpi1031.com. We have tons of access of materials, educational materials. There's a blog on there with hundreds and hundreds and hundreds of things. We have a newspaper that we publish throughout the year, just going over case studies and industry news. We have a magazine that we publish. So anytime if you have or if you want to sign up for those, log on, email us, and we'll get that out. We have everything you see on our website from an educational material also comes as a hard copy. So if you prefer, like myself, not to be reading a lot of information on a computer screen, we can mail you a hard copy version of our magazine, newspaper, book, and different, white papers and things like that. So, with all that said, we really appreciate everybody's time today. And again, as you see below here, you can reach out via our website or our email.
All right. Thank you so much, Che, for that information. That was really nice. I like the examples. I just put up a poll question for you all if you do want a consultation, just to make it a little easier for me to connect you with Che and his team. If you say yes, I do get your email and then I can forward that along and you guys can schedule something after this webinar. So definitely take advantage of it. Che and his team, as he was saying, are super experienced in this. And so if there's anyone to talk to about this, if you are considering it at all or now or in the future, I definitely think you should take advantage of that. So I'll leave it up for just a little longer, and you can also put questions in the question box. I see Lisa and Frank already put some questions in there, so we're going to start with those. Lisa asking if some of my investments are in disregarded entities, single member, must I put them in my personal name prior to selling them if I want to do a DST?
This is a CPA question. I can say from a high level, I've seen both ways. Wasn't anything I advised on. The other thing too, if where what I have seen happen is someone has, their entity, which usually if it's disregarded just means it's reverting back to you anyways, from a tax reporting standpoint. But um, if there's not an appropriate time, say you're selling sooner and you didn't have time to fully dissolve an entity or get rid of it, once you come into the DST and exchange into there, we can always change title on your DST investments. You just want to make sure before, changing title that you're not triggering anything because some things might take longer to, dissolve and change. Like you have different it might be, wait 2 tax years to do X or wait a tax year to do X. And so that's where your CPA will come into the picture. But the moment you say, hey, I need a change, then we'll send you the proper documentation to change the title to the DST. And if you want to, I didn't hear who answered or asked the question, but if anybody wants to jump on an individual call, I have a lot of resources through tax attorneys and CPAs, especially locally here that I'm assuming most of us all on this are in Southern California, that I can give references or at least get some high level answers for you so that you don't go all the way down a rabbit hole if there's just like a very simple answer we can get.
Great. Yeah, Lisa says, yes, I would like to have a call. So, Lisa, I will connect you with the team after this so you can get more on that. Frank asking, we file a joint tax return. All of our properties are shown on the return, but not shown on it by which spouse owns which property or which are jointly owned. She has one which we've rented and depreciated for 20 years, and we want to 1031 exchange it. Can she quit claim deed it to me or gift deed it, and then I can 1031 exchange it in my name? The history of this property on our tax return doesn't state whose name it's in. So unless the IRS questions it, and why would they, since it's been on our joint return for 20 years, is it okay? Because we show it is an investment property, and at my death, it goes to her at the upgraded basis since I'm older, 13 years older. Lots of information there, very specific. I'm not sure, Che, what do you think based on what
Yeah.
you heard?
So what I'll do with that is if you can email me
Mhm.
that situation, whether it's you or the person who answered
I
it, my
can send it to
email,
you. Yeah.
yeah, and my email for everybody is just
Mhm.
my first name, CHAY at KPI1031.com. And I can take that segment. Obviously, I won't give up your personal name or anything like that. And I will send it to some of those CPAs and tax attorneys,
Mm.
and they'll probably get me back kind of a starting point for you before you have to like spend money and go down a rabbit hole with the CPA or attorney. So
That's
definitely
fantastic.
send that to me and I'll try to work on that.
Great. I put that in the chat for everyone if you want to copy and paste Che's email directly and get ahead of things. Che, I'll send you the Q&A as well so that you have people who asked the question and their email in case you also want to reach out to anyone asking questions today. That is a really good question. And I think it's really great that K Properties has not only access, obviously, to what you all are experts in, but also to experts in that CPA kind of industry that are working with multifamily owners and investors. So that is so nice to have. Also, Frank saying already in touch with their rep in Charlotte. Awesome, Frank. So glad that you're already in touch with someone at K. That's fantastic. Brent Lindbergh, he's asking, what if the sponsor is not desirable? Can he be fired? Not all
Yeah.
sponsors are great, but I think K Properties does a good job of finding good ones. What do you think, Che?
Yeah, there are, ultimately on a DST. So when a sponsor creates a DST, they are typically the trustee on the DST. So just like if you had a family trust, you could potentially have, it could be you as trustees, or you might hire someone to there. So there is some responsibility as the trustee to follow. And if they're not, ultimately following, there could be a potential process to, ultimately remove them. We tend, a lot of, as you'll start to see and explore, some of the names of these sponsors you are pretty, some are household names, some very large institutions. It's not, it's not just a local, person who does a one-off DST, or, a local property manager. So I've never personally been in a situation to date where a sponsor's been removed from there. Could it happen? Yes, if that were the case, but we try to just avoid and have our investors in and with sponsors that have a track record or that we've worked with for many, many years. And it's rare that we bring on a new sponsor that we haven't worked with. The only exception to that would be when they're like a big household name, like let's say Blackstone came into our space. And there's groups like that where they have a lot of other experience within the real estate world and track record where we could, make sense versus, the local syndicator popping up and doing a DST or something like that.
Great.
So
That's a
the
good
short
point.
answer, though, to kind of not interrupt
Mhm.
you, is we'll walk you through the track record, the background of any sponsor prior to you, choosing that.
Excellent. Brent asking, do you market investments from someone who is reselling theirs? And how is the resale value if one needs to cash out?
Yeah, so there are like secondary transactions that take place. They're not as frequent as you might think, but it has happened over the years where we've helped investors maybe sell earlier than the DST was going to sell. Like maybe the DST had a business plan of like 5 to 7 years, and it's the investor got in a personal situation and they need some level of money now. That value is ultimately up to you as the owner of what you want to try to sell it for. We might educate you and help you, where it's valued. Obviously, the real estate's going to be tied to the economic market. The other thing is how fast you need the money. Like, do you need the money tomorrow, or or you have a couple months to kind of figure it out? Very similar to real estate. If you were selling a piece of real estate outside of some trophy assets, it usually takes you 3, 6+ months to, prep a property, get it sold, etc. But the short answer is we have successfully been involved in those secondary transactions to assist our clients. And we've had only a few scenarios where people took a discount on their price. That was specifically where these things were sold in, under a 2 week period. But if you have time, the market, is in your favor and the property's performing and doing what it was, we'll do everything in our power to get it out there. And the good news on our platform is we have I think over 45,000 accredited investors that have reached
Wow.
out to us. This is not a list that we bought.
Hmm.
Over the last, almost 2 decades, just investors that are accredited that are reaching out to us. They're not all clients, but we have a very massive investment of being able to market stuff too.
That's an incredible list. So lots of experience. A few more questions here. So actually two questions, one from Annabelle, one from Tinny about fees. So what fees are associated with the transfer of funds into a DST? And then also what's the overall percentage fee that you charge? Maybe just a quick breakdown of that to clarify it for everyone.
Yeah. So this is going to be a much more in-depth conversation. So I'm going to answer it very high level. But I encourage you to reach out to us so we could actually probably set up one of these Zooms. So all the fees are going to be disclosed in something we call a PPM, a private placement memorandum. So we're required, by a regulatory to disclose these. So they're not anything that's hidden or anything like that. And so what I like to do is usually have like a Zoom call like we're doing now where I could share my screen and kind of walk investors through how to, look at the PPM and understand where the fee sections are. But from a high level, there's upfront syndication cost. Some of those syndication costs are actually dealing with buying the property, right? Because remember how I said before, the sponsor has to go out and close on this asset. That means they've spent money on legal teams, due diligence, anything they had to do that probably you would have spent if you were buying a property. They might do a few more extra things just because some of these big institutional deals might require more potential due diligence. That money is built back into the offering. So it's technically a fee, but however you want to view it, it's money that probably should have been spent regardless. DSTs, as a DST structure, you cannot do a capital call. So the if the roof goes out or leaking, you can't go to investors and say while you're inside the DST structure and say everybody has to pitch in $10,000. So because of that, another fee is, or it's considered a fee, but is a reserve account. So the sponsor might look at the business plan of say it's a 7-year hold or 10-year, what potential things, or through our property condition report, are we going to have to redo the parking lot during the hold period? What kind of curveballs can pop up? And hopefully create a healthy reserve account that might not even all be used. If those aren't used, those are investor-owned money, and they'll be distributed back at the sale of the asset. But we have to disclose them as a fee in the PPM. So I guess where I'm arriving at is I'm not getting any of that, or people aren't receiving that reserve. It's for the benefit of the property. The third kind of section of the fees is where we all make money. Full transparency. No one is doing it for free. And that's between almost like a real estate commission and the sponsor might make an acquisition fee, is a lot of times what it's titled in a PPM. Those can honestly range from all different sponsors and strategies. I've seen anywhere from 2 to 7% on average, and you're going to know that too. So all of a sudden, you just want to target the lowest fee deals, and we target those. There could be reasons on other deals. We recently I was involved in a transaction where you're buying from a distressed seller that's about to go into foreclosure. So it kind of offsets some of the fees depending upon how well the sponsor bought that property. And that's another thing that we'll kind of walk you through. But yeah, I encourage you to set up an appointment and we'll walk you through the PPM of those upfront. And then obviously there's property management fees or asset management fees, but not all deals have a property management fee. Multifamily, yes. FedEx distribution center, no. So, it just depends on the asset class.
Okay, I can see why that was a complex question.
Yeah.
It's not just one number. It kind of depends. So, but it sounds like, you're flexible as to what you can find depending on what you're looking for as an investor. That's
Yeah.
great. Another question was how long do we have to keep the investment with you? Um, Also coming from Tinny, and she also asked, or he, how do we determine the investment you choose for us is sound? So how do you choose the investment, and then how long do you keep it, essentially?
Yeah. So every DST will have a projected business plan. different hold periods and things along those lines. And we are very clear to make sure that investors are comfortable with those hold periods. Because if you need your money in 3 years from now, DSTs just might not be the right route for you because most DSTs are 5+ year hold periods. And that's because this is generally stabilized real estate, meaning it's cash flowing, it's not development deals, it's not a flip situation. And anytime you have real estate to create value, you usually need to be in something for an extended period of time. And so we'll walk you through that. We want you to be comfortable and or take some chips off the table and pay some tax, like I said earlier. And in terms of strategy on which deals to pick, that's really where it's important to engage and even well ahead of your exchange. I mean, we have some people we talk years before their exchange, but at some level before you actually sell, because we can start to walk you through all the pros and cons, build what I call kind of a style box for you. Um, and the most important thing is you will always get to decide what investments you go into. We're not telling you to go in only this or that. We want to educate you and you make the decision.
Great. Yes, you have a lot to choose from. I mean, K Properties has massive offerings on their platform, so that's helpful. Brent, for the last question here, what kind of income would be average for a multifamily 100% cash investment?
So there's a range, because obviously it can, as you can imagine, it can depend on where a property is located. Cap rates are different in, Los Angeles than they are in, Arkansas or wherever. A lot of our properties are, we have stuff in California from time to time, but a lot of it is kind of in the Sun Belt, like Texas to Florida, the Carolinas, Virginia. There's just a lot of growth there. A lot of people don't realize, I think it's something, don't quote me exactly, but I think like 80% of the population, somewhere around that number, 70, 80% of the population in the United States is on the East Coast. So that's where a lot of the or west, not the Western United States. So a lot of the population, a lot of jobs, companies, they're all kind of based in the Sun Belt kind of East Coast region. So that's where a lot of the target properties would be. But with that said, depending on the strategy, is it Class A trophy type asset or is there value add components to it? There could be net projected cash flows, and cash flows are never, guaranteed, just like your properties you own now yourself. But they can range, we have stuff on our platform ranging anywhere from 4 to 6%. And that's net. There's a difference between a net cash flow and a yield, right? So it's depending on how you look at it. When we say net, that's just, hey, that's the money coming in my pocket. Now you might have a tax equivalent yield of 7, 8, 9, 10%, depending on like depreciation and all this stuff. But what you see on our website when you log in there, just know that's the net cash flow. That's not an after-tax equivalent yield. That's not a IRR, meaning if you like we have some sponsors where they have an average annualized return of 14% or 15%. On a per property, when you're looking at our menu, that's just the net cash flow. If you want to go over a track record of a sponsor, track record of similar assets, that's where we can kind of individually walk you through.
Okay, great. Well, that concludes questions. Thank you for staying a little later, Che. I did just drop in K Properties website in the chat, so you all can click there if you want to go. I think signing up is a great idea. So, I can just share with you real quick what that looks like on their site. So, this is their site. This is the Delaware Statutory Trust book. If you guys registered, you were asked if you wanted that, but it does have here the ability for you to register, the marketplace that you can explore. So lots of different resources as well for free here on the site. I highly encourage you to go to it to learn a little more. You can also call them or schedule a call again, if you did say yes on the poll, you'll expedite that process. So it'll go directly to them today and they'll know that you want to get started. So I'm going to stop there and thank you all for joining us. Again, this is recorded. We will send you the slides as well. So that'll be sent out anytime between now and end of day tomorrow. And then we'll also give you all of the contact information as well and recording. So, Che, thank you again for joining us and teaching us about DSTs. This was a great presentation and you answered so many questions. So, thank you for staying a little longer.
Yeah, thank you. And thank you for the opportunity.
Of course. All right, everyone, have a great day. We'll see you soon. Bye.
Bye.